So as mentioned earlier, today we're going to focus on the IRS Section 280A. It's most commonly known as the Augusta Rule. So as you can guess, if you follow golf, it was created due to the Masters Golf Tournament. Residents of Augusta, Georgia wanted to be able to rent their homes out to the people attending the Masters Championship. And they wanted to be able to do that and also make income and not have it be taxable. So the Augusta Rule was kind of created. It allows people that are homeowners to rent out their home up to 14 days per year. The income they make from renting their home out for 14 days per year or less doesn't appear on their individual tax return. So again, if you want to get technical, I posted kind of a snippet of the text language down here, but I won't read that and bore you to death. But again, just to kind of re-stress the stress, it's any taxpayer that owns a home. Obviously, your home can't be your primary place of business, but a home office would not exclude you from taking that. So it also can be used on a secondary home and vacation homes as well. So if you are lucky enough to have a cabin on a lake or near a ski resort, you can rent those out to potential clients. So how does it work? So again, just really repeating a lot of the main themes, but the taxpayer must own the home and they must be renting the dwelling out. This dwelling must be their personal residence. So that doesn't mean it just has to be a house. It could be an apartment, it could be a condo, it could be a boat, it could be a mobile home. It's just, it really has to be your personal residence. Again, unfortunately, expenses to have this dwelling unit are not deductible. So like your taxes, your mortgage insurance, and your mortgage, you can't deduct out of the income you're earning from this, but that's okay because you're getting the 14 days in rent if that's what you decide to do as free income. So you can't write off any expenses for this. Again, the letter says less than 15 days. So I always just say 14 days. So again, you can rent your personal residence for 14 days. It doesn't have to be consecutive. A lot of people will rent their residence out for their business as a quarterly meetings. So, you know, they may do 3 days for Q1, 3 days for Q4, Q3, and then like 5 or 6 for Q4, or they can switch it depending on where they live. So the main thing is just 14 days or below. One nice thing is depending where you live, if you were like in LA, you could have rented your home out during the Super Bowl and got significantly higher rents for renting that out. Or if you live in the South or in a college town, you know, you might be able to rent out your house during home game day weekends and make a decent profit tax-free. Let's say you have a vacation home, and where I live, you have McCall and Sun Valley has pretty big ski resorts. And if you had a home there, you could rent that out during New Year's, around New Year's or during the ski season, and you could charge a pretty nice premium for those. Again, the key part is 14 days or less, and it doesn't have to be consecutive. Pricing, I'm sure we can get some feedback on the community that's used this, but you got to use kind of market rent or market rates. So you can get those based on going to Vrbo, Airbnb, HomeAway. If you live in a bigger city where there's hotels, you can see what a hotel room would cost to rent for how many people are attending this business meeting. You can get quotes on what a conference room would cost. So you'll just have to really research places that you could host a business meeting that would resemble what your house is, so you can have audit proof for the IRS that I paid X amount and it was within a reasonable range. Again, down there, as I kind of said, use a rental website. I've already mentioned those. You just really want to track how you determine what your rent was. The reason that's really important is the next step is, this is what to me is the most appealing aspect of the Augusta Rule. It's the ability, if you're a small business and you run your business, you can theoretically have your corporate meetings, you can have business meetings at your house and rent your house out for 14 days a year, or a vacation home. So you're able to expense costs from your business, which is going to lower your business income. And then that 14 days in income goes to your personal return, but you don't have to report it. So you, in essence, have just shifted dollars from your business to your personal income. So it's a really neat opportunity if you have a small business and you are a homeowner. And it allows you to double dip. Then kind of here's just a very basic example. Is Jason's an owner of a small business. He does quarterly meetings and he wants to rent out his vacation home for 14 days. And to rent that home for 14 days is going to cost him $10,000. So what Jason's able to do for his small business, he expenses that $10,000, lowers his net income, but then that $10,000 shifts over into his personal tax return. So Jason, in essence, took $10,000 from his business, put it in his pocket using the Augusta Rule, and just kind of on a potential tax rate saved about $3,500 in taxes. So that's what's really nice about the Augusta Rule, is you're able to kind of double dip, and depending where you live, you may be able to save significantly more based on the market rates and rental rates or cost of hotels. So again, bigger cities, you're probably going to even get more tax savings. So that's kind of the slide deck for this Augusta Rule slide. It was a topic that was requested. I kind of purposely made it short so we could have more of a discussion and Q&A on this after this presentation, but this will also be available in our materials and ROS. So I'm going to stop sharing my screen and then we'll go to the chat and then answer questions.